Okay, good afternoon. Luando Franklin is my name. I'm the Chief Executive Officer and the lead tutor at FCL Accountants Tuition Center. Today, I'm going to deliver a lecture on financial instruments. This lecture is suitable for all the students that are doing financial reporting. Now, I want you to pay particular attention. I'll specifically look at the definition of financial instrument, illustrations, and the accounting treatment for compound financial instruments in the books of the issuer. So those are the aspects that we are going to look at. Now, financial instruments are regulated by IAS 32. IAS 32, which deals with classification and presentation of financial instruments in the books of the issuer. We also have another standard, IFRS 9, measurement of financial instruments in the books of the holder and the books of the issuer. We also have IFRS 7, which is disclosure of financial instruments. So we have three standards here. Now, IAS 32 defines a financial instrument as a contract. A contract that gives rise to both financial asset in one entity and financial liability or equity instrument. In another entity. So that is the definition of financial instrument. Each time when you come across financial instrument, you must be thinking of financial asset in one entity and financial liability or equity instrument in another entity. So I want to give a simple illustration. A company provides a loan to B. The provider of a loan is the holder. Very important terms. And the company receiving the loan is the issuer. They will issue a certificate under company seal acknowledging the receipt of the loan, hence the name issuer. In the books of the order, that will be financial asset. In the books of the issuer, that will be financial liability. That is the first illustration. Second illustration, we have C makes a credit sale. A credit sale to company D. In the books of C, you treat D as a receivable. D will treat C as a payable. So a receivable is a financial asset, and a payable is a financial liability. Number 3 illustration, we have E buys equity shares. Equity shares in F. Now, these equity shares do not give E control, no significant influence, meaning there is no parent, there is no subsidiary. Significant influence is not there, therefore there is no associate. There is no investor and there is no investee. So E will treat these shares as equity investment. Equity investment is a financial asset. Then F will treat this one as equity shares. Which will be equity instrument. Now, I've given 3 illustrations which fit into the definition of financial instrument. And now, it's very important to understand the difference between financial liability and equity instrument. Students have challenges there. Let me just explain there. Financial liability. How do you know this is a liability or it's equity instrument? Financial liability, which we call debt. Financial liability, which we call debt, one major feature of a financial liability is that the issuer has a contractual obligation to deliver cash to the order. Very important. The issuer has a contractual obligation. Contractual obligation to deliver cash to the order. Now, again, if there is no cash or to deliver, other assets, to deliver other assets on potentially potentially unfavorable, potentially unfavorable conditions, potentially unfavorable conditions. To the order. So now the borrower has potentially unfavorable conditions. The terms will be unfavorable when it comes to settling the obligation using other assets or exchanging the financial instruments. Now, what about a financial, now, equity instrument? Equity instrument. The entity is the issuer of the shares, has no contractual obligation to deliver cash. So when a company issues shares, they are not going to pay back. So those, you know, it's equity. The issuer of shares has no contractual, no contractual obligation, no contractual obligation to deliver cash or other assets. I want to expand here. That's why when a company issues shares, equity shares, there is no legal obligation for it to pay dividends. Dividends are paid as a board, as a discretion of the board. So dividends are paid at the discretion of the board of directors. So that is equity. Now we go to the financial asset. Financial asset. Financial asset, we have the order of the loan as a contractual right to receive cash, as a contractual right to receive cash or other assets from the issuer. Are we together there? Financial asset, the order of the loan as a contractual right to receive cash from the issuer or other assets on potentially favorable, potentially favorable conditions. So those are the explanations on the financial assets, financial liability, equity instrument. So now I want us to focus on the question which came as an adjustment. We are focusing on hybrid financial instrument or compound financial instrument. In the books of the issuer. One example of a compound or hybrid financial instrument is convertible on stock. Convertible on stock is an example. According to IAS 32, a convertible on stock or compound financial instrument should be split into the debt component, and equity option component. Now, how do you do the splitting? First, you need to determine what is the debt component. Now, the debt component is the sum, is the present value, is the sum of the present value of coupon interest, and the principal amount. The principal amount discounted using effective interest or market rates. Now, it's very important to understand the effective interest. Effective interest is the interest of similar loans, but without the conversion option. That becomes the effective interest. Now, after getting the debt component is remeasured. The debt component, is remeasured at amortized cost. Remeasured at amortized cost. Remeasured at amortized cost. Equity option is not remeasured as per conceptual framework. It is the residue, the balancing figure. So now we can look at this question, which came as the adjustment here together. We have this one here. Starts from there. On 1 January 20X7, each company issued $80,000 4% convertible loan notes. So that is compound. So you need to find one, the value, the fair value. Fair value of the loan is equal to the number of units, 80,000, multiplied by the value per unit, 100. This gives us 8 million. Now we are told that the loan notes, first we need to know 4% convertible loan. The interest attached to the loan is what we call coupon interest. The loan notes can be converted into equity shares on 31st December 20X9 or redeemed at par on the same date. Now check here. An equivalent loan without the conversion right would have required an interest of 6. So this is the effective interest. So we are given this interest. So now we can calculate the debt component. Debt component will be debt component will start with the coupon interest. %, or we can use thousands instead of million to make our work easier. So this will give us 320. So now the debt component, you discount here, cash flows, discount factor, present value. So here we use the effective interest. Remember, the effective interest is the interest rates of similar loans, but without the option to convert, which we are given to be 6%. So year one, there will be 320, which is the coupon interest. Year two, there will be 320, which is the coupon interest. In the final year, there are two components, the interest plus the principal which is 8,000. 8,000 plus 320, it gives us 8,320 here. The discount rates to use are these, which is the effective interest. So there we have 0.943, there 0.890, 0.840, present value, when you multiply, this will be 302. This will be 285 when you round off. This will be 69.89. The total will be the debt component. So the total there will be 75.76. The total principal is 8,000. So the balancing figure is the equity option. Equity option there will be 424. Now, I want you to understand that the debt component must be remeasured at amortized cost as per the requirement of the standard. So amortized cost. Amortized cost, we have debt component, we have 75.76. Effective interest, we add. The effective interest is 6%. 6% there, it gives us 455. Less coupon interest already paid. Now, students make mistakes here. Coupon interest does not change. It is based on the original loan. So here, the coupon is still 320. Then there we have 7711. This will be the non-current liability, which is a loan, the loan component or the debt component, measured at amortized cost. Now, the effective interest of 455 will go to the P&L as a finance cost. So for today, we can end here the lecture. Please, if you have not followed some items, ensure that you get in touch. And whatever questions you are going to raise, the team at FCL, they will respond to you and will give you the appropriate solution. For today, we end here. See you in the next series that we are going to deliver. Thank you and God bless you.